Welcome to Focus On, bringing together financial industry experts of different horizons, sharing and discussing their insights.
Ladies and gentlemen, thank you for joining us and welcome to today's event, Focus on Amazonization. The term Amazonization, in the sense that we're using it today, derives from a report that we published back in 2019, which you should be able to access via the event registration on our website. In the report, the term refers to the ongoing shift of financial services towards being provided by digital platforms, and the ensuing increase in transparency and comparability of such services, and then also the greater availability and usage of data and financial services, both in terms of as a product, but also to meet customer needs. Obviously, this is an ongoing and broad-based change, and we could have easily used an alternative term to describe this trend. We could have talked about Uberization or eBayization or perhaps even PayPalization, with the point still quite clearly being that the way in which we're consuming financial services is increasingly online and tailored, and with this trend only being accelerated via the COVID pandemic. The event today will look at this topic both from a data angle but also from a platformisation perspective, looking at what it means for the industry, for the regulators and for consumers. And so without any further introduction, let's get started. So I'm delighted first to be joined by Sherry Madeira. Sherry joined LSEG via Refinitiv as the Chief Industry and Government Affairs Officer in March 2019. She joined from the City of London, where she was an economic ambassador to Asia and special advisor. After the merger of Refinitiv and the London Stock Exchange Group, Sherry now leads a team across all LSEG divisions, including capital markets, post-trade and data analytics, and she'll be talking to us today about the new data economy. So Sherry, the floor is yours.
Wonderful. Thank you so much. Thanks to everyone at the Luxembourg for Finance team for inviting me to speak today on such a timely, impactful, and broad topic. I think that the title of the overall session here is Amazonization. And it's a word that's taken on new meaning since we've all weathered the COVID-19 crisis, punctuated by knocks on the door with our own personal deliveries from the world outside our home bubble. So we know the word well. But in the sense that we're using it today, we're defining it as the shift in power to consumers driven by online platforms. And this applies to many industries and supply chains, including financial services. And we've experienced an increased use of data and digital platforms for payments, identity verification, remote infrastructure, including trading floors. It's therefore logical for me to address today the one building block of Amazonization for financial services. I think that has got to be data. So I'll share some thoughts on new data landscape, how it's shaping society, particularly as we build back better post-pandemic. And to set expectations, I'd also likely to share more questions than answers. But that's the nature of innovation. And as per Luxembourg for Finance requirements, I'm going to attempt it not to be boring. So let's think about the demand for data. In recent years, the value of data has grown exponentially in the minds of actors across our global economy and our society. To meet the growing demand, the amount of data generated annually worldwide is expected to grow from 33 zettabytes in 2018 to 175 zettabytes in 2025. So that's the equivalent to storing 12 trillion top-of-the-range Apple MacBook Pros. Or for those in the audience that are less IT geek and more dreaming of a holiday, 1 zettabyte is equivalent to all the grains of sand and all the beaches on the earth. So it's a lot. So why so much? Why so much data is being generated? Investors, in fact, are demanding more and more reliable data to allocate capital, aligned with their values, to manage their risk more effectively, and to make greater returns on their investment. Policymakers are increasingly aware of the role data can play in unlocking innovation, tackling societal problems such as climate change, and ultimately building back better from the pandemic. The cloud, natural language processing, machine learning, artificial intelligence, these are all high usage of data. And so there's a lot of different avenues that data is coming down. The tools are being applied to many issues, from the vitally important to things that are quite simple that we use every day, putting the smart into smartphones. So as a leading provider of data to the financial services industry, operating in over 190 countries worldwide, LSEG is a special vantage point when it comes to the evolution of the global data landscape. So financial services industry is a long-standing user of data, going back to 1851, when Paul Julius Reuter used pigeons to carry stock market quotations between Aachen and Brussels. Until a reliable telegraph link became available, this was the method used. So, of course, I'm referencing the early days of Reuters, which evolved into Thomson Reuters and then spun out into Refinitiv as a pure financial and risk business. And then it was required by LSEG in February of this year. So a few changes from pigeons have developed along the journey, but the importance of data, be it real-time data, trade data, country risk data, carbon emissions data, is just as important. And LSEG's Refinitiv network delivers 40 billion market updates daily. The Refinitiv network alone can process up to 7 million updates per second across 70 million instruments, faster than a pigeon. So now that we hear data is the new gold, this is a phrase I hear quite often. I don't know about that. It infers that it is immediate value to the holder. The reality is how you use data unlocks its value. Moreover, who does that value belong to? What we can agree on is that we're all sitting at the heart of a changing landscape, where financial services firms are increasingly demanding and using new types of data, delivered and deployed in new ways. In this new landscape, firms are looking at how to optimize their data through centralized data lakes to connect their enterprise data infrastructure, data tagging, aggregation, storage, differentiation through big data, predictive analytics, flexible delivery. This is where it starts getting its value. The financial industry rewards pioneers that embrace statistical methods and data analytics to drive unique methodologies. So it's been an early adopter in financial services. For example, 90% of financial services firms are using machine learning in at least one application today, and 75% of them describe their investments in new data technologies as significant. So what are the two key macro trends to note? One, the first is openness and flexibility. So the internet has allowed us all to be incredibly connected. This has created massive economies of scale in shared storage. It's rationalized a shift towards global data ecosystem, and it's increased connectivity and the use of centralized data lakes. Consumers and customers have been accustomed to on-demand services like Amazon and like Netflix, and the financial industry has followed the same path. Customers increasingly expect data to be delivered flexibly through open platforms that enable workflow customization. We all expect things instantly. We all expect them to our quality standards. The second key macro trend is the globalization of data. To enable this trend towards openness and flexibility, data has become and needs to remain a global business. International free data flows are critical to innovative solutions. One example is in third-party risk. Companies use cross-border data sets to track their operations through multiple jurisdictions and manage risks consistently and comprehensively on a global scale. In financial services, the demands of compliance with anti-money laundering legislation are high, rightly so. In this example, access to global data to verify identity across borders is essential to minimizing fraud. Getting this wrong is abating illicit fund flows, and it'll also land industry players with enormous fines. So both the reasons of the carrot and the stick, risk needs to be managed by data flowing to where it's needed. Another example we touched on earlier is AI and machine learning. Free data flows allow for real innovative analysis using large data sets to take advantage and develop new tools. And finally, that use of cloud. We talk a lot about it, and companies are taking advantage of opportunities through the cloud by combining data sets, using richer analysis, and reducing costs by accessing flexible computing power. Ultimately, all of these uses of data can help to power our recovery from the pandemic and take us towards a sustainable and digitized world. But back to that question, who does the data belong to? The question of data sovereignty sits at the heart of data regulation. It's the data generated by an individual or their own property. Is it their own property to hold, to share, to sell? I'm not talking only about personal data. That fits easily into the privacy bucket, and we all know about GDPR and privacy legislation. We're familiar with that territory, but what about the transactions we've all made in the last year over our phones, our tablets, our laptops, to buy goods or services, to contact friends and family down the street or across the ocean, to share on social media some views or questions that we might have on health, on government, on business, on each other? So who owns that data? The question is not simple, and different jurisdictions take different views. I'm going to make a vast generalization here, which has many examples of exceptions. Europe often looks at data as being owned by the person. America, that data is owned by the companies that collect it. And in Asia, that data is owned by the state. Of course, that is ever changing, and sweeping statements that include the word Asia by their nature are flawed, since I don't believe that there's any such thing as Asia. But it makes you think about how data will be able to be monetized in different parts of the world. If data is the new gold, whose gold is it? Another phrase we frequently hear is that data is the new oil. Well, as a hydrocarbon and a non-renewable source of energy, I have an issue with this analogy as well, particularly as we're considering the climate crisis and the role of financial services in sustainability. Here too, data plays a central role for success. Recently, more financial decisions include environmental considerations and data to channel investment towards low carbon activities. Thus, environmental data needs to be improved. It needs to be the 3 C's: comprehensive, coherent, and comparable. When we talk about sustainability, we often use another 3 letters, which is ESG, and that's calling out the environmental, social, and governance data points. Why has the discussion around ESG data exploded in the last few years? And I think notably, I'm going to speak mainly about the E, because the S and the G data is lagging. The social and governance is behind in terms of getting data points that investors or society can use. But if we think about why this is exploding, investors are looking at value, their values, and the values of their customers. 98% of global institutional investors take ESG data into consideration when deciding to invest in a company. In contrast, 83% of those same global institutional investors cite data as the obstacle to effective assessment. This may seem an oxymoron, but actually, we can commend these findings. It is evidence that the market is using the data they have to move forward, even if it isn't exactly what they want or need. The climate challenge in particular is so urgent and important. Investors are careful not to make the perfect the enemy of the good. ESG data is a higher demand also to measure risk and compliance. That old adage plays out here too. What you can measure, you can manage. Financial institutions are increasingly recognizing the need to incorporate climate-friendly risks and their risk management frameworks. This applies to both physical risks and transitional risks. Of course, we can't ignore investors' use of ESG to actually seek alpha. Particularly in Europe, it is increasingly the case that SDG-aligned investments lead to higher performing investments. Refinitiv Lipper data shows that almost all SDG screened portfolios have outperformed the benchmark, or are at least on par with it. Index-linked securities investments are also looking closely at ESG. This year's FTSE Asset Owner Survey shows that pension funds in EMEA are considering how to measure climate transition to manage climate risks and opportunities. The vast majority, 81% of asset owners based in EMEA that evaluate the use of smart beta expect to apply ESG considerations, and that's up 8% from last year. Among those who anticipate applying ESG to their smart beta strategy, the majority, 64%, anticipate applying climate themes. So it seems that ESG data will be an important part of the financial data offering going forward, and its increasing usage is directing the market to improve and to expand its offering. However, there are challenges, and the global sustainable data economy needs improvement. The data isn't good enough. The data is just not available. The disclosure is not good enough. So these are the comments frequently shared first in person and now in virtual panels like this, the world over in the last few years. In addition, there's a loud and strong call for better standards for ESG, including disclosure requirements for public issuers. This is tied closely to the increasing regulation and legislation in the area of sustainable finance. The EU is notable in its pace and its depth of sustainable finance regulatory reform. The EU has an ambitious sustainability agenda, and it's underpinned by a robust mandatory ESG reporting framework. It was used to be called the NFRD and has now just recently been changed to the CSRD. But what it means is that it's expanding the number of companies in scope for disclosure. The SFRD, another acronym to think about in Europe, is the Sustainable Finance Disclosure Regime, and it's already in effect. It's in phase 1 and it'll move into phase 2 soon. Again, more to do with disclosure and transparency. Most famously, the EU Sustainable Finance Taxonomy has been published and is moving expeditiously through to implementation. But the EU is only one of many jurisdictions creating legislation. It's a veritable taxomania out there, with versions coming from China, which actually launched its taxonomy in 2015, predating the Europeans. Canada is looking at transition-led taxonomy. The UK is consulting on its taxonomy. Malaysia, Singapore, the list goes on, including Russia and my favorite, Mongolia. The exuberance is laudable. The dedication is inspiring. But the challenge will be to build the bridges across borders to make them globally useful and interoperable. Here again, I know I'm getting predictable. Data plays an important role. A common definition of the data sets needed to underpin the taxonomies can help drive usage and global benefit. But I want to call out that we're not just banging on about sustainable data being essential, but flawed. We're doing something about it. I'm very honored to be the chair of the Future of Sustainable Data Alliance. It's a coalition of the willing, formed at the World Economic Forum in January of 2020, together with the World Economic Forum itself, the IIF, the UN, and a number of other founding partners that span the globe, including Tsinghua University from China and Oxford University in the UK. Its purpose is to determine what data sets are needed by industry and regulators globally to move capital sustainably at scale and to recommend paths to improve data availability. Specifically, there are a few work streams that we're working on now. The data gap, a well-defined data set that still requires populating, is in need of fixing. But even more importantly, the data hole, which is where we know we need data to measure and monitor a material impact, but neither the data or the structure exists in order to be able to define it. Both data gaps and data holes are a key requirement for investors to be able to manage their risk going forward. So Future Sustainable Data Alliance, or FOSDA for short, is looking at how it is we can map data gaps and data holes and make recommendations to fill them. A great example of a data hole is biodiversity. Data in this field is not mature. Only 20% of the universe of companies that disclose ESG data, which in itself is not comprehensive, disclose data points relevant specifically to biodiversity. We likely need new ways of thinking about data for biodiversity. The use of geospatial data paired with asset location disclosure can be very powerful. And these ideas start pushing us forward in terms of how it is that investors can continue to do no harm. FOSDA also has a work stream focused on forward-looking data. I'm going to give you another three-letter acronym or three-letter grouping here. Forward-looking data is unique. It's outside of disclosure data, which is being well championed by TCFD and other groups. Forward-looking data has particular risks, which we like to call the 3 E's: estimation, extrapolation, and errors. And yet this data is essential for other forms of regulation picking up pace, including from prudential regulators worldwide. The NGFS, the Network for Greening the Financial System, has gathered a group of worldwide central banks and are looking at how it is that they can actually champion disclosure through the banks that they supervise and align scenarios and try and find ways of stress testing portfolios. So data may not be the new oil, but perhaps it can be the new energy if we can close the data gap and holes for investors and regulators so that they have what they need for the future. Data challenges in sustainable finance are not the only challenges in our new data landscape. One other notable challenge is the rise of data localization. Global data flows in the year 2000, 21 years ago, were negligible compared to current volumes. There was a really important inflection point in 2016, and McKinsey study estimated the cross-border data flows may have raised world GDP by roughly 2.8 trillion. And now digital trade is growing even as global GDP growth rates were falling. And the COVID-19 crisis has emphasized the value of digital services and connectivity as economies struggle to maintain operations in the face of the pandemic. A recent IIF economic paper has highlighted 2020 quarter-on-quarter growth of e-commerce in the US at 30%, as it accelerates towards accounting for a third of all retail sales. So we see these flows in our LSEG data as well. 92% of customers in the Americas access data from EMEA and 87% from Asia. 92% of our users in Asia access data from EMEA and 94% from the Americas. 87% of our users in EMEA access data from Asia and 93% from the Americas. I really do like my data. So why would anyone want to localize data if that's the case? So the trend of data localization did begin with some of the emerging markets, the BRIC countries in particular, and centrally controlled economies. But this has spread to even more developed markets. And that international trend has emerged in recent years towards the restriction of data storage and technological infrastructure within national or jurisdictional boundaries. The drivers for this are often protectionism or security-based. Data localization comes at a cost. I've spoken a lot about the importance of data innovation, sustainability, and financial services. All these areas have compounded inefficiencies if data are not able to be shared across borders. So in conclusion, Amazonization has been proven as a strong trend for our future, which reaches across many industry segments. In order to make the most of this digital trend, we need to embrace data as a primary input into our digital lives. There are challenges in doing so, but there are also solutions rapidly evolving to both the technological and social dilemmas we face. I don't believe data is the new gold or the new oil, but perhaps data is something more fundamental. Perhaps it is the sand, the 175 zettabytes and growing worth of sand, which means we have a lot of beaches in our future. More importantly, sand is the fundamental ingredient to make bricks. With a solid foundation of data bricks, Amazonization and our digital future rests on solid ground. So I thank very much your time and interest this morning. As promised, more questions than answers, but I look forward to listening to the panel that's coming after and wishing you all a good day. Thank you.
Okay, thank you very much, Sherry. I think you well and truly fulfilled that brief of making it interesting. Great to hear that data isn't something new, but dates back at least in terms of usage to the 1800s, but is rapidly emerging as a foundational technology. Driven by trends in data globalization, data ownership, and then consumer trends, and then some of the challenges that it faces in terms of data quality, data gaps, and data comparability. So thank you very much for joining us today and sharing your views with us. We'll now move on to our all-star panel, tackling the shift of financial services to financial platforms. The panel will be moderated by Nasir Zubairi, a successful fintech entrepreneur and CEO of the Luxembourg house of fintech, The Loft. Nasir has spent 13 years working in capital markets at RBS, ICAP, HSBC and EBS, and has been immersed in the fintech and startup sector for over a decade now. In addition to his role as the CEO of The Loft, Nasir sits on the IMS High-Level Advisory Group on Finance and Technology and on the OECD's Blockchain Expert Policy Advisory Board. Today he'll be joined by three panelists. Claire Kalmergen is the Chief Innovation Officer at SocGen and a member of the Group Management Committee, a post that she's held since September 2018. Prior to that, she had a number of heavyweight innovation roles at the Lloyds Banking Group, as well as a range of consultancy positions in technology transformation at Capgemini Consulting. Also joining the panel is Edward Glynn, Managing Director and Head of Global Markets at Calastone. Edward joined the management team at Calastone in January 2014 to lead on global client strategy, following on from 20 years in the fund distribution and security servicing industry. Prior to joining Calastone, Edward spent 9 years at Swift, as well as a number of years in key commercial and strategic roles at Investia, former parent company of JP Morgan's Fund Hub, ERI Bancaire, Thomson Financial and Tagen. And then last but not least, we have joining us in the studio, Anders Lacour, who is CEO of Banking Circle, a fintech which he launched back in 2013, following on from a successful career as a technology and financial M&A lawyer. Anders is also the inaugural chair of the non-profit business association, Emerging Payments Association EU, having been on the EPA advisory board since 2016. And with that, Nasir, I'll now hand over to you and your panelists.
Fantastic. Thank you very much, Chris, for that warm welcome, and hello to you all tuning in for this panel today. I'm very glad to have such a range of experience on this panel from the finance sector, from those working in traditional finance, and some work of digitalization. As Chris has mentioned, this panel is dealing and tackling with some of the issues that are coming up in terms of the broad digitalization in the financial services industry, or as the Luxembourg for Finance published as part of their report in 2019, the Amazonization of financial services. So welcome to you all. Thank you all for being here with me today. It's a great pleasure to have you. This term that Luxembourg for Finance coined, Amazonization, that could mean a whole set of different things to different people. So, I mean, let's maybe kick off with setting a little bit of a foundation here. What does that term specifically mean to you? And how does it impact your strategy and your business strategy going forward? Let's start off with Edward, please.
Hi, good afternoon, and many thanks to Luxembourg for Finance for the very kind invitation to be here. Absolutely great opportunity, great honor, and delighted to be with such an esteemed set of panelists. You mentioned the word Amazonization. It's a very difficult word. I keep mispronouncing it. But to me, when I think about Amazon, I suppose two things firstly spring to mind. When people use Amazon, it's all about the trust that they have for that particular platform, as well as the influence that Amazon has on the wider industry. And again, two more things that I think really, for me, underline the Amazon experience. Number one, it's their use of data to make a very dynamic, personalized client experience, and all of that married with what I call fulfillment. So, I think of Amazon very much traditionally as a fulfillment shop, but that client experience married with the frictionless of the fulfillment side of Amazon. That's to me what Amazon is all about.
Okay, thank you very much for that, Edward. Claire, how do you view this as part of your role in Societe Generale? I think you're muted, Claire.
Sorry, thanks, Nazir. I was trying to say Amazonification or Uberization of banking. For me, I link them back really to our strategic plan in SocGen, around three pillars. First, the client centricity. And obviously, Amazon have set a standard in terms of customer experience through digital. And it's very important for us. And today, we're very proud, for example, in retail, to have about, 60%, so 18 million of our 30 million clients using actively digital at least once a month through online or mobile, and doing, in average 30 transactions a month, 30 connection with your online bank, which is huge, and a huge opportunity, obviously, for cross-sell, upsell, better contact. Second pillar is really around efficiency of our strategic plan, and here we will work a lot around, the data, as Edward have mentioned, where we have more than 80 AI use cases which are live, such as, for example, predicting, the recoverability of your overdraft and being able to focus on customers that have the most important needs. And then our third pillar is all around ESG, especially post-pandemic, and how finance can support, some of the 2-degree scenarios change. So for me, I link them back as how are we organizing, our strategic plan, against new entrants, but it's also an opportunity for partnerships. And obviously, Amazon also, have a lot of operations. So, for example, in our business of car leasing ALD, we've done a strategic partnership to distribute cars. And actually, Societe Generale is the first worldwide company where when you go in the Amazon website, you actually are in the Societe Generale digital pages. And we had to adapt all the infrastructure in order to meet some of the standards of Amazon. And obviously, more and more, it becomes a standard for the industry and how we do that. I think the second part for me where I relate to this Amazonification is what we call the world of platforms. And today, banking and oil have been leading by market capitalization the world for 10, 15 years. And it's not anymore the case. Today, it's platforms who own nothing, who are marketplaces. We are a place where they create a new market between their customers and the provider that are leading, in market capitalization the world. And for me, financial services have to find its way in this new business model. And in banking, we decline it in two different parts. The bank as a service line. So it's about providing, part of the infrastructure to corporate neobanks, fintech. And Société Générale did a strategic acquisition of a company called Trésor, which was a leader of bank as a service in France and now present in 7 countries in Europe. And have 80 different clients, neobanks, fintechs, and providing that. And the other one is obviously bank as a platform, which is a complex one because, even with 30 million customers in retail, we're very small compared to 7 billion that some of the meta platform have. And therefore, we have to think harder what can generate a network effect. And we have a couple of projects going in this area, partnering with fintechs, offering different propositions in the platform.
Okay, Claire, thank you very much for that. Anders, your thoughts on this area? I mean, we heard a lot from Claire around how the Société Générale, and we know likewise other banks are looking to digitalize. I mean, you run a new age digital bank. I mean, it was digital from the get-go. I do remember when Banking Circle was first set up under a different guise many years ago, but it was always digital first. How do you see this digitalization of the finance industry, and do you think you have a competitive advantage as a result of sort of being digital first and not having the legacy behind you that needs to change in itself in the way you deliver services?
Yes, it's a very good question, because I think what we're looking very much into when we look at both amortization and also the way we approach digital is that it's an API first strategy for all the newcomers in the market, meaning the FinTechs, the big group of clients that have emerged as a consequence of the implementation of the Payment Service Directive. When you then look at our place in the value chain, we have historically had to both accommodate what you could say the old players in terms of the banks and the newcomers. And with the newcomers, the way for us of looking into the digitization and the APIs is, I think it was Dave Birch who quoted amortization with the process of manufacturing products through APIs, and then also looking at the consumption of these products through APIs. And this is very much how we look at it from the new client group's perspective. And again, the older, you could say more legacy heavy players like the traditional banks, we have to approach this in a different way. So we actually have had a twofold strategy or a dual strategy behind our launch.
Thank you very much for that, Anders. Maybe, Edward, coming back to you, this element of Amazonization, I will use the term a few more times before I give up, because I know I'm going to say it incorrectly at one point in time. Amazonization and its impact, and it has a sort of competitive advantage within the finance industry. I mean, what has been your experience? How do you see it driving competitiveness, and when do you think this will really start to kick in as sort of a differentiator? Is it now? Is it 5 years, 10 years time? Let's hear from you.
Well, I think there's probably a few things to point out around Amazon first, and then perhaps look at the parallel of those figures with our specific industry. So, looking at various figures, there are about probably 200 million Amazon Prime members. And I think that figure in the US certainly grew 25% over the past year. But let's break that down somewhat. So 50% of Amazon Prime members complete their purchase within 15 minutes. 28% of those Amazon Prime users buy whatever it is they're looking for and complete that transaction from start to finish within 3 minutes of starting to look. So if we also parallel that with understanding why, and this goes back to Claire's point, why people use platforms or marketplaces, 26% of US shoppers cite efficiencies as the reason why they use a marketplace as opposed to going directly to a retailer. And when we say efficiencies, the two things that they particularly cited, I think the first one was buying something with a single click or swipe, and things like saved payment information. Now, I think 51% of those Amazon Prime users cite free shipping as the prime reason why they use it, and 46% mentioned the sort of frictionless payments. So with all that in mind and using that as a parallel to our specific industry, Calastone came in to the industry 12 or so years ago with a single, if you like, raison d'être. And by the way, I hope you thought that French accent was good for an Englishman in England. So the raison d'être of Calastone was all around removing friction. And when you look in any market around the world, any market, any country, any asset class, when you remove friction, volume goes up, cost and risk go down, and the client experience goes up as well. And from my perspective, and we're operational in about 47 countries around the world with the largest global fund transaction network. And in key markets like the UK, Hong Kong, Singapore, Taiwan, Australia, we have probably between 70 to 80% actual market share. So as in 7 or 8 pounds of every 10 pounds that goes into a fund is powered by us. So we see a tremendous, I suppose, amount of data to understand what's really going on in the industry. So I think the thing that I would have to say most is that the purest form of alpha is cost reduction. And for me, that is what this whole Amazonization is all about. It's about making the industry more interesting, more compelling, more user-friendly, but then encompassing all of that experience, that whole end-to-end transaction lifecycle in a way which is as frictionless as possible. So you rip out any unnecessary cost, you make it easy, it's cheap, it's more viable, and everyone wins.
Thank you, Edward. Claire, banks and financial institutions still seem to sell products. And I mean, I put it to you that not that customers of or clients and users of financial services don't really want products. They want to be enabled by financial services, and digital, I think, is doing a lot of that. And it was interesting hearing all the projects you've been working on, SocGen, and I applaud the efforts we've had. But can a traditional institution really move forward effectively in this world and create a new sort of paradigm in terms of the way they deliver solutions and compete with the, call them Amazon first type digital businesses that have been arising over the past 10 years?
Yeah, I think that's what we are doing, Nazir. But as I mentioned, we are not just competing, we are also collaborating. And I think it's very important. So if you look at our innovation strategy, obviously we've done several acquisitions. I mentioned Trezor earlier, but we also acquired Shine, which is a French neobanks for freelancer, which is a platform model. Shine, before being a bank and offering bank services, actually offered a way for freelancers to set up their company, to deal with the administrative part of it, wanting to remove the administrative burden. And at one point, they find that offering bank accounts and payment and cards and expense and way to manage your expense was part of the proposition. And actually, first they turned into Trezor before we acquire them to provide these services. And now, back last year, it's been a year, we have acquired Shine, and Shine keep growing. And for us, our strategy is not to integrate Shine as part of one of our business, is actually to develop a digital first business model. And we've already done that with Boursorama, the first French online banks, which today account for 3 million clients in France, have announced 200 million of profitability by 2023 and 5 million clients target by 2025. And is rated by D-Rating as the A-, so the highest note in terms of digital experience. And we have other example, behind Shine, we also did another acquisition, for example, of a platform called Rizocar, which is a marketplace. So for me, we are in this game. We are doing this new business model. We are transforming, part of the experience through new business model, but also, as I mentioned, through the numbers, through the acceleration of our current business model. Again, I think what we have to not forget is in the traditional distribution model, so also through branch and telephony, there is a different type of customers. And, in Société Générale, of course, we serve clients like you and me. We also serve mass affluent and wealthy clients, small and medium enterprise, large corporates, and financial institution, FI segments. And all these clients don't have the need to see all their, relation digitized. When you are a small, medium enterprise, of course, you want much more dashboard, especially post-pandemic, you want to develop the e-commerce. But, when you are preparing your succession or when you want to sell one of your business and to enter in a new business, these are type of operation, moment of life, where generally you want to be with a banker, or when you are in the private banking segment, most likely you want to have, an interaction. And here digital is supporting and enhancing our senior banker. So we believe there is also an alternative model that will keep existing and need, as mentioned by, Glenn, it need to optimize. Of course, part of our cost base, you need to be always, more intelligent around data. It's important, but for me, it's a clear alternative also to the Amazon model and to the new entrants that are here, and ones that I see, going beyond 10 years line that you are giving us.
Yeah. Claire, if I maybe could just stick with you, because I have a follow-up question. I want to ask you about costs and cost savings in a bit later on, but you talked about all the different segments. I was reading an interesting report this morning about the wealth management segment, a segment that obviously SocGen also covers, mass affluent, ultra high net worth and high net worth, and where it said that specifically millennials are dissatisfied in general with the digital services of their wealth management advisor, that they spend 43% of their time when engaging with their investment advisor, doing it via a mobile phone, and that they are highly likely to switch providers relatively easily. Historically, traditional institutions have relied a lot on trust and the lock-in with clients. Do you think this changes, this dynamic changes going forward with sort of the new generation and the mass transfer of wealth that's coming about over the next 10, 15 years to these generations?
There is two parts to your question, I think. The first one around, the new generation. And here, I often say, people are often asking me, is digital more for young people? Is there a segmentation? I've worked in different banks and not just in SocGen, and there is no segmentation. There are young people that don't use digital. There are, people that, feel very comfortable with digital. There is no reason, basically, it's not dependent of a typology or different things. The only thing we can say, and I can see that in Boursorama, our client base generally is more urban, and Boursorama is the most preferred bank in the segment of 15 to 24 years old, and we are not seeing a lot of churn. So when they have their account in Boursorama, basically they will use most of the services that are provided through Boursorama. And you're right, engaging through the digital technology. But again, I cannot say that it's I cannot generalize that. I can only know what I have in front of me. I think the reality is we are still very early. I know we forget that mobile banking is just there for 10 years. So it's not so long, in the edge of technology and different things. The second part to your question about the trust in the business model, I think actually it's a difference with Amazon, and the GAFAs in general. GAFAs obviously are monetizing part of the data. They are monetizing it at the moment of e-commerce, as their goal is that you will buy the product as quickly as possible. Banks, I think, have a differentiator point, and at least that's what we believe in Société Générale, that we can play a role by leveraging our position of trust, in the solution we offer and the way we offer it, especially with, you may have followed some of the conversation around cloud and sovereign cloud, where we are very engaged. In Société Générale, more than 80% of our application have moved to the cloud, and we built a private cloud in order to be very strict around our data privacy and data localization. And we're very engaged today in the conversations that are happening, especially in France, but it applies across all our business. And I think it's a differentiating point. I think banks should not give up, this area of being the trusted partner, and it could probably lead to some new business model, including in wealth management. Why not around health also, and protecting some of the data that are very sensitive. But it's very long term. I cannot say that we have short-term plan around that in Sogei.
Okay.
Leslie, can I just pick up on a couple of points that Claire mentioned, which I think are, again, very interesting parallels between a bank and an online platform. I think first is the difference between whether a mutual fund is sold or whether it's bought. Certainly in the UK, products were traditionally sold, they weren't bought. Whereas again, on the likes of an Amazon, it's bought as opposed to sold. And your point was very interesting around client loyalty. So Amazon have a conversion rate of 69% in terms of people who trial Amazon Prime and then go and buy it. After a year of using Amazon Prime, 93% have stayed with it. And after 2 years, I think it's 96% have stuck with it. And then if you look again at the reasons why people use it, almost half of all people, one of the main reasons that they use a platform or a marketplace like that is the ease of finding products. So I think those are some interesting statistics when we think about how our industry needs to adapt even more to that kind of consumer experience.
I find your points very poignant, Edward. I mean, it's the thing that bamboozles me to this day. As you said, we have a choice where we do our online shopping, and ultimately, because of the experience, we do choose Amazon in huge numbers. With banking, we kind of make do because the alternatives are just about the same. Most people I know, including myself, still have a bank account with the first bank that they opened an account with, usually around university. So it's been quite sticky. The evidence suggests that the newer generation, which may be not the core focus at the moment of the banking industry, but ultimately become the high net worths and the ultra high net worths at the end of the day, don't have that kind of loyalty and are willing to switch around a bit more. But talking about loyalty, and if I may come to Anders Banking Circle is a fantastic example of a new institution, relatively new institution, let's say. I mean, you've been around for, I think, 15, 20 years now, maximum, I think, as a whole, with a bit of a shift in a business model. You can explain a bit more about that better than me, Anders. But how getting trust to compete as effectively as you do, and how did the traditional sector, how have you seen them respond to this, and how do you continue to stay ahead?
I think our focus has been very much on being an enabler. And in that aspect, I think we launched the business because we were quite convinced that in an age where you have a combination of digitization and deregulation with the Payment Service Directive, all entities competing for the retail clients would move up the value chain, and they would leave the infrastructure part simply empty, because no bank would like to be a white label provider of services for a tech unit or for a fintech business monetizing on a client base. So with that in mind, we took a very, very concrete approach to actually build that infrastructure layer. And today, Banking Circle is turning over 155 billion euro a year in e-commerce volume, which again is a substantial part of the European space. And with that in mind, our approach was to be like, anyone should use an infrastructure party outside of their domestic core. So our vision was quite clear here that it was partnership all the way through. Like even the largest banks on the planet have areas or geographical areas where it's not their core. And there we step in. Similar with the FinTechs, a lot of priorities they have to deal with, development of new product features, building stickiness to the end clients, and again, they can use someone like us for that purpose. So much more partnership than actually competition.
I mean, this debate could go on forever. I think we have about 5 minutes left, so I'm just going to ask a couple of last questions. And I think amongst the many sort of critical things I can think of, I don't think we can end this call without talking a little bit about regulation, and particularly regulation in Europe, a hot topic. How is that all, in your opinion, keeping pace with this digitalization of the finance sector? Maybe let's go to Claire.
Sorry, two aspects of regulation. The first one, obviously, is I think I talked about the sovereign agenda, and this is going to be critical as we move forward. But then I think regulators are catching up and adapting quite well, in terms of customer protection, for the more traditional platform. And you may know that, but at EU level, they are working on the Digital Market Act and Digital Service Act, which are going to govern part of the platform data and institute a new level of data privacy protection and operation. Because very interesting the numbers that Edward mentioned. I think what is more important is to understand, does customer understand they have enrolled, they are paying, and what is it doing for them? And again, I think this is very early on the cycle to understand that. The second area on regulation around new business model, I think we are seeing that Europe is booming today in terms of the technology sector, which at the end of the day is good for everyone, create a lot of employment in Europe, a lot of new business that can be very successful, and set the competition for traditional organization. And I can say that we are totally ready for it in Société Générale, either through partnership, either because we believe we can compete on these segments.
Thank you, Claire. And Edward, I mean, European regulators are keeping up with the technology, or do you think they understand it and are implementing rules around it effectively?
Nazir, it was a little bit crackly at the beginning, but I think I heard the question, so I'm going to answer it. If I answer the wrong question, please tell me otherwise.
Sure.
But we found most of our engagements with the regulator has been very much the regulator wanting, well, they regulate the business model, not the technology, and we're very much in the technology space. But we found thus far that the regulators are keen on increasing trust, transparency, and value back to the end investor, and making markets more with increased structural integrity. And all of those things very much suit us, how we can make the market better, faster, cheaper, more efficient. So at the moment, we've found the engagements that we've had with regulatory bodies have definitely not been a barrier, but very much an enabler, because it's forcing our client base to look more acutely at how they can be better, and then they come to people like us to provide those solutions.
Thank you, Edward. And Anders, you received your license in Luxembourg not a few months just before everything went into shutdown. How do you view the world of regulation, and how's it impacting you in a positive or negative way?
I think you can say that we were born as a consequence of the first Payment Service Directive. So in that way, I think the EU regulators or the EU governments did quite well in being that forward-looking with the first payment service directive. I think the second payment service directive then opened for a lot of other features, including open banking. And in general, I think it's been a very encouraging trend in Europe over the past 10, 12 years that I hope will continue. It has, as Claire alluded to, laid the ground for innovation. And I think if you look back in 5 years on the entire journey of opening the competition for the financial markets in Europe, it's been a highly successful move.
Thank you, Anders. And I think just to close, one last succinct question, and hopefully a succinct answer from all of you as well. What one thing do you desire or think should be done in order to either to spur change and make the biggest difference to your organization, be it something that affects change?
I think I would stay in the world of regulation, and then I would say, like, obviously on a day-to-day basis, if you look at the big picture of the legislation, it's very, very well. If I had one decide, was a harmonized framework that was interpreted exactly the same way by all regulators in all countries in Europe, that would be an amazing thing. Where it's a dream, but at least this would if we knew exactly that the German regulator and the regulated Scandinavian countries had the same way of interpreting the regulation, that would be an amazing thing.
Now, harmonization across the EU, that would be a wonderful.
Probably slightly easier response from me, which is that I believe that the technology is now there. We have enabled all of our 2,500 institutional clients to leverage our blockchain-based distributed market infrastructure. So I believe that the technology there and the business case is there for change. When I look at where we have been successful over the past year, it's by creating a competitive landscape. So probably the biggest deal that we've done over the last year has been one client coming to us and saying, we have lost lots of assets and lots of clients over the past year, and we now understand why. It's because we had provided a solution to a particular competitor of theirs, and they've now asked for something similar. And when we see now the effects of DLT on both the administration side, so we've launched a fund services offering, as well as in the sort of distribution tokenization side, I think that the greater success we have with projects, with clients and initiatives, I think that will create even more competitive impetus and a competitive environment. And that will inspire change for other players, because they will see that they simply cannot afford to embrace this kind of technology and opportunity, because they'll simply die otherwise. So competition.
Competition. Thank you, Edward and Claire. What one thing do you dream of? What could make a big difference?
I think I share some of the dream of Anders and Edwards, but for me, it will be really around the technology for good. And maybe I will take one example because it's so broad and so large. Of course, it can help to solve financial inclusion. And I think for me, I choose to do this job because I think digital is really an opportunity to rethink banking, to rethink the customer experience and make accessible something that is complex, sometimes that can be perceived as being complex. And one of my favorite projects is really Société Générale Forge, which is basically a leader in security token today, working with the French regulator in terms of providing a CDBC wholesale. And the promise basically is to have a new infrastructure, first in capital market, but it can go in other area that is more instant, more transparent, that enables us to really understand where the money is going in the economy, how can we fuel it better, and what can we do more with everything we have already.
Fantastic discussion that could go on and on and on, but unfortunately we have to bring it to an end. Thank you all for listening in, and good day from me, and I hand back to the studio.
Well, thank you very much, Nasir, Claire, Edward and Anders for that very interesting panel, which, despite some technical difficulties, I think really hits home some key messages, particularly around the desire for increased harmonisation on an EU level, then also increased competition, and then the possibilities for inclusion that new technology brings. Also great that you ended with a discussion around regulation, as that gives us a very nice segue into our next event now. So I'm now delighted to be joined in the studio by Karen O'Sullivan, who is Head of the Innovation, Payments, Market Infrastructures and Governance Department at the CSSF. She coordinates the activities of the department, which is responsible for financial innovation, both in the application process and then the ongoing prudential supervision of payment institutions, EMIs, market infrastructures, as well as then oversight and remuneration of governance practices and policies implemented with financial institutions. She's obviously also in charge of the department that's responsible for financial innovation, and that means that Karen and her team are a privileged contact and entry point to the CSSF for the fintech industry. Great to have you here in the studio.
Thank you.
Let's just get started. So one of the one of the questions that I have is one of the byproducts of financial services obviously being delivered increasingly online and digitally rather than via brick and mortar operations is that the issues around knowing your customer are perhaps a little bit more complex due to a lack of physical presence. So what's your perspective on some of the challenges here and how to go about tackling them?
It's certainly very clear that over the last while, particularly in the pandemic times, that the way operations and getting to know your customers had to change. And there's been a shift, as you said, from the brick and mortar to the more digital online platforms and interactions. It's not just COVID related, because we started to see a shift towards certain of these tools even before the pandemic. But it's clear that the pandemic really heightened the need or the necessity for financial institutions to adapt. Whilst there was this adaptation to a new way of doing things and a new way of continuing businesses and maintaining business continuity in a way for certain of the financial instruments, there wasn't a similar shift in the AML KYC regulations. So the ultimate kind of restriction requirement to know your customer and to make sure that your service, your product, your goods are not being used for money laundering or indeed terrorist financing means, methods, whatever, hasn't changed. So that means that the financial institutions really have to adapt and to get the same level of knowledge and verification of their customers, but again, using different tools. So whereas before they were able to kind of meet with the individual, check, we'll say their ID to the person sitting in front of them, ask a few security questions, and at the end say, yes, this is the person I have, they can't do that today. There is no meeting. So what's necessary is to arrive at a comfortable way of testing documents that they're receiving digitally and really checking it back to the identity of the person. And I think it's a huge opportunity, because by kind of encouraging these more digital ways of exchanging, it's quicker, it's more efficient. It clearly respects or probably answers the consumer's desire to have an easier process, a quicker process. But the problem as well is that as these techniques are increasing and becoming more developed, the dishonest people amongst us are even more dishonest, and they're adapting even quicker. So the tools that we have today to really check the identity and the verification of documents are always a step behind the tools that are there to forge the documents. So I think it's very important for the financial institutions to be aware of that kind of a new risk. And to really understand and accept that their responsibility regarding identifying and verifying their client hasn't changed. They have to have the same level of comfort, the same level of assurance of the person, albeit with new digital tools or the other. And I think when we look at the way of doing that, I think clearly eKYC, EID, ID or digital ID, they're solutions that can be used. And it's up to the institution to really incorporate it into their way of doing things. I think what's important as well is perhaps to make a small distinction between two, say, key techniques. So one is more video identification. So here, it's certainly not something that's new. I mean, we have FAQs, or we had FAQs on our website that data back to 2016 about video identification. So here, it was the original use of digital tools. So there was a video rather than a face-to-face meeting, but there's still a human intervention. So there is a human there who can kind of use his brain, shall we say, and test certain things. On the other side, what we have more and more now is more fully automated tools. There is no human intervention in the first initial onboarding step. There it's using things like selfies or videos that are being uploaded to an app, and then the app is using biometrics or other techniques to make sure that basically the video or the selfie that's been uploaded is corresponding to the traditional paper ID document that they have. So here, there's no individual being used in that initial step, but that doesn't mean that further down the line there's no need at all for individuals and other safeguards or other controls to be put in place.
Mm-hmm. And so just to stick with that briefly, what would you say a good eKYC process looks like in your opinion?
So I think in a way a good eKYC process it shouldn't really change anything in the overall AML framework that an institution puts in place. Because as I said, they still have the same, the institutions have the same requirements, and they have to get to the same level of assurance and combat money laundering and terrorist financing. So it's really key that whatever solution is being used is fully integrated into the overall framework of the institution. It's not because a tool is being used or accepted or fit for purpose for one institution that another institution can automatically use the same tool. It really has to be adapted to the framework, the business model of the institution, its own risk appetite, which again varies from one institution to the other. So I think it's really key that it's embedded in that framework. And as I said, that the institution, we say, fully recognises, accepts, understands that he does have professional obligations that need to be respected, and he needs to perform them. I think it's important then to look at these solutions and maybe again adapt maybe the mitigating or the management of the risks that are behind. So when we're looking at automated tools, then clearly there's more a need to look at the operations of the system, to make sure that whatever is coded into the system is working properly and that it's capturing what it should capture. But also when you're looking at the systems, to make sure that ultimately there's an individual somewhere that's checking to make sure that they're functioning as they should be functioning, and not have a blind faith on, well, it's in the system, so the system takes care of everything and that's okay. I think when we're looking at more automated tools, typically the clients that would be onboarded using those more automated tools and not the more traditional face-to-face or semi-face-to-face type encounters would typically be considered as high-risk clients. And because they're high-risk clients, well, then there would need to be at least an annual review of those clients to, again, making sure that all the documents, the file, everything that's on file is up to date. And there is the compliance officer. So that's something that the system can't, fully do by itself. The system could be used to maybe send out reminders or ask to get documents or receive the documents, but there has to be that level of control by the compliance officer to make sure that those restrictions and requirements are met. And I think that goes back to an overall due diligence then that the entity really needs to do. So that's when we're talking about integrated in-house tools. If it's being outsourced, so either the tool is, somebody else is maintaining, operating the tool, or maybe it's a platform that's there. So really it's outside the entity itself. There we get into all these outsourcing considerations. It doesn't change. I mean, the ultimate questions and considerations around outsourcing remain the same. It's just we're talking about a different tool. Here, perhaps when we're talking about AML, the main difference is that when we're looking at outsourcing is to see what service the outsourcer is actually providing, because depending on what that service is, it may be necessary that the provider has a license. And if it needs a license, typically it's what we call our support PSF license that's needed. If it's simply a tool that's been hosted by somebody else, so you're just outsourcing, we'll say just the pure verification or identification, well then probably no licenses would be needed. If though that service provider is being used maybe to maintain the documents, maintain them up to date, Perhaps, as we said, contact the client when things need to be updated. Any of those type of things that are kind of add-ons to the pure identification as such, well then it's probably going to fall into the support PSF license. So I think really a good KYC process should be the same as a good eKYC process should be the same as a traditional KYC process, just in a way making use of these tools or techniques to remove the tedious piece and ultimately improve the consumer satisfaction with the service.
Yeah. Okay, so no black boxes, humans are still important in the process, and you have to tailor it obviously to the institution you work in. And actually, talking about outsourcing brings us on quite nicely to my next question, which is obviously with the rise of financial services being delivered by online financial platforms, we've also seen an increase in the use of API type interfaces to integrate financial services together from different companies, perhaps, so into one overall user experience which the customer enjoys. But does this present any problems in terms of supervision from the perspective of a regulator that multiple services are being delivered by different companies who delivered via APIs? Yeah.
And I suppose the very simple answer is probably no, but you don't want that answer. And probably you'll see that some of the answer is, it's in a way similar to what we've just said for eKYC. I mean, our mission as a regulator is really to supervise the financial sector, to make sure there's financial stability, and ultimately to make sure that there's protection of the consumer. The fact that there's more and more use of digital platforms, it doesn't change that role, it doesn't change our objective. What it does change is maybe how we need to kind of act or work to meet that objective. So I think it clearly it adds layers of complexity, because when we have one entity in front of us who does everything, well then we have one entity and it's kind of easy to go and discuss and to supervise that one entity. When you've got different layers, well, first of all, there's different entities or a number of entities to be supervised. And in today's digital world, not all of them are in Luxembourg. So there's also additional or slightly changed, shall we say, cross-border aspects to take into account. So there's no, in my view, no new risk as such. There's no new real problem or challenge to the supervision. It's more seeing how all these techniques or platforms or solutions kind of accentuate certain of the risks that are there already today. And then our supervision needs to be around those risks and making sure that they're managed, they're mitigated, and everything works as smoothly as it should. And I think for that, when we look at the entities, the increasing use of digital platforms, it creates more, we'll say, operational risk. So we clearly have things like ICT risk that takes on a whole new form, a whole new importance. There's possibly reputational risk, business conduct risk, because if there's an increased use of platforms, well, then the entity has maybe less control over cybersecurity issues or aspects, maybe less control over the consumer data that's there, how it's used, what it's used for, maybe less of an direct influence, at least as to how their products are being marketed on the platforms, because possibly they don't have their hand on the platform. So it's increasing those type of operational risks for the entity. It also increases or accentuates their compliance risk, because again, we have consumer data. So once, I think today we mentioned consumer data, there's a whole range of risks and requirements and regulations that come into play. So really the company or the entity needs to make sure that the data is protected, it's safe, it's properly used, it's used for the reason it's supposed to be used for. I mean, I think we all know that a small data breach today is catastrophic for any company. So it's really important for them to understand where the chinks are, where the kind of the weaknesses are in the process, so that they themselves can focus their attention to those aspects to minimize the risks. Customer consent, obviously, it's kind of a follow-on. It's key. I think today, I mean, how many of us receive emails to say, sign up to our data and privacy, and we click it and we don't read what's in it. As a consumer, that's our prerogative to tick and not read. But the entity who's receiving those ticks and receiving those emails needs to make sure that it has the proper information and that it's protected. Yeah. And there's no excuse, and they can't defend kind of that kind of a breach. Maybe from kind of a more regulator perspective, as I said, I think it complicates things for us, and we go into more and more cross-border type territory. And I think for us, what's clear and key is transparency. clearly transparency is needed on the consumer side as well. But I think for us, transparency and a really clear description and understanding of the business model is really key to what we try to do. And in a way, it has two objectives. Well, the first objective is so that we can understand what's going on and we can really target our supervisory actions where they're required, where they're most necessary. And while targeting where they're most necessary, we're also targeting ultimately the company that's responsible for those aspects. So that's kind of one aspect of the transparency. But sometimes the other side of the transparency is by us asking, say, our financial entity to really clearly describe and explain what exactly they're doing, where their role and responsibility ends, albeit when we're outsourcing, they can never fully delegate responsibility. They still maintain ultimate responsibility. But really, if we can get them to explain where their role and immediate responsibility ends, and in all the layers of we'll say, outsourcing and the digitalization, whatever, the different intervenants and where kind of their role, what their role is, where it stops and where it's passed on to somebody else. And quite often by putting those questions to the institutions and forcing them to think, and forcing them to really think the whole process from start to the end, they themselves sometimes realize where the weaknesses are. By themselves, they can, by giving us that explanation, they can kind of see, oh, well, this, we're maybe not mastering the way we should, or here we need more oversight, or whatever it is. And again, the objective of the whole thing is to make sure that it's fair, it's transparent, and all the regulations are really respected today.
Yeah, absolutely. Well, I mean, we're rapidly running out of time. Maybe just one last question, which is, picking up on something that Claire said in the panel, which obviously the increasing role of cloud infrastructure. What's the regulator's perspective on the use of cloud in terms of delivering financial services? Because obviously, I mean, that's a kind of a foundational layer for these platforms these days.
Yeah, I think, the cloud, it's a key enabler to the digitalization of financial statements. It's key. Contrary to what many people might think, we are very favourable of the cloud, and we always have been. I mean, not to go into the history of it, but way back in 2017, we already issued our own circular on the use of cloud, what cloud was, what it meant, how it can be used or how it could be used, and what safeguards, controls, whatever the entities needed to put in place for them to be able to really take full benefit of the efficiency and the advantages of the use of cloud. Subsequent to our initial circular, so EBA had different guidelines on cloud and outsourcing generally. We then updated our circular, I think it was back in 2019, after the EBA guidelines. And basically where we are today is that we favour the use of cloud as long as it's in a controlled, managed and fully compliant way. Initially, when it was, we say, newer, any use of cloud needed to be, or an application file needed to be sent for us to pre-approve a use of cloud. I think with the experience of the market on using cloud and our experience in overseeing the use of cloud, we've been able to evolve a little bit. So what we've done now is now it's again 2019, but what we've done is we've changed, and now we only need to pre-approve any use of cloud for material outsourcing. And in a way, it was really to refocus energies and attention where it needed to be. So it wasn't kind of using of cloud for email systems, for instance. It was really the use of cloud for the core activities, services of the institution. And by changing it and moving from a complete notification for everything to a targeted notification, it meant again that entities need to really analyse what they want to use it for. And they need to do the due diligence, and then they need to put it all together in an application form, so that we can check then that the securities, the security measures, the oversight, and whatever else is there, and it's being properly put in place. And again, depending on how it's being used, it could bring us into the realm of outsourcing again, and then we go back to what we said about outsourcing and managing it.
Well, great. I mean, obviously, we have run out of time, unfortunately, but it's been a great discussion and great to have you here today. I mean, obviously, this is something that is going to be an issue for quite a long time, I think, and it's definitely a trend that is only being accelerated over the last 14 months or so. So with that, I'll say thank you, and we'll move on to the next section.
Thank you.
Okay, and so we'll now move on to the last session of the day, and it's my pleasure to be able to welcome to our virtual stage Sean Byrne. Sean is the CEO of PayPal Europe since June 2020. In his role, he leads in ensuring that the company meets all of its regulatory requirements. As a partner to and an enabler of PayPal's business, Sean is contributing to make sure that PayPal is serving its partners and customers across Europe. Previously, Sean was COO of PayPal Europe, where he was responsible for credit, governance, change management, outsourcing, and technology. And during his 17 years at PayPal, he's had various roles in the areas of compliance, controllership, as well as financial and strategic planning, working in Luxembourg, Dublin, and Shanghai. Prior to PayPal, Sean was also head of operational risk in Daiwa Securities and finance and risk manager at NatWest. So, Sean, great to have you here today.
Thanks, Chris. Delighted to be here. Thank you.
So just to kick off with, maybe we could talk about a bit of history. So PayPal has obviously been licensed in Luxembourg since 2007. Could you perhaps talk about how that license fits into your European presence and also how it fits into your overall global strategy, perhaps?
Yeah, absolutely. As you mentioned, we've been licensed here in Luxembourg since 2007 as a bank. That provides us with a lot of opportunities to passport that license across the European Union. And it's a very flexible and effective way of operating our business in our very strategic and important European market. We have over 75 million active accounts within the European Union itself. And if you look at the broader European franchise, we have over 130 million accounts within the broader region. So you can imagine that's a particularly important franchise for PayPal globally. It's also a very strategic from us because all of these accounts tend to be very advanced in how they operate. So we look at this market as a particularly important one for us. It provides an opportunity for us to add a lot of our functionality into the market. So we provide products that we wouldn't be able to offer if we weren't a full banking license in the region. Examples of that would be our recently launched QR codes, which was launched last year during the pandemic, which allows people to pay in a contactless fashion with merchants using the PayPal app. We also offer a range of products in the credit space, such as Buy Now, Pay Later, which provides the functionality to pay in 3 or pay in 4. That's available across a range of markets, including UK, France, and Germany. So overall, a very strong package of opportunities for us to grow and operate within the region. As I mentioned, we have our banking license and we passport that across the entire European Union from Luxembourg. So it's a very seamless way to operate, leveraging that license from our central hub in Luxembourg. We also have offices in 10 other European countries where our staff provide a range of services such as back office support, in-country strategy, and marketing advice. So, a strong presence for PayPal in the market that we consider very strategic. When we look at this market, it's also a very innovative market. So we tend to look for new venture investments here as well. We have a number of investments in startup companies like Think, which have done very well for us in terms of accessing an ability to invest in a new company starting up in this space. So very attractive for us overall.
Cool. Thank you very much. Now, obviously, you highlighted it slightly already in your intro there, but one of the things that the world has obviously been going through over the last, say, 14 months since March last year is the COVID pandemic, and that's obviously been quite a big driver for contactless and digital business. And maybe you could talk through some of the impacts that you see that having on PayPal's business.
Yes, yeah, absolutely. I think we've all lived it in our everyday life, and we've seen it as a payment institution. Digital payments has gone from being a nice to have to an essential service, and PayPal is in a strong position to support both merchants and consumers in that journey. from our perspective, we see a digital-first environment emerging, and that's embraced by both consumers and merchants. And it's erasing the difference between what was traditionally a physical shopping experience and an online experience. Of course, in the pandemic, consumers moved online in very large numbers. And what we've seen is as the lockdowns have reduced and released, we've seen a continued elevating use of online activity by consumers. They have obviously seen the convenience, the ease of use, and the time savings by using online payments and e-commerce activity, and that's something they want to continue. When we look on the merchant side, we see merchants changing their business model to adopt to that new environment, looking for home delivery, click and collect, and all of those other aspects that allow for a strong e-commerce franchise for merchants to operate. Research that we've seen indicates that overall digital payments have accelerated or leapfrogged by 3 to 5 years during this time period. So a tremendous period of acceleration that has benefited the online space. And as I say, I think that's a continuing trend that we see going forward as well. I see that at a personal level as well as at a macro level. Our broader family business is in the ice cream kiosk, very traditional storefront business, perfect for these summer times. But what we definitely saw was this traditional business, which was a heavy cash usage, moved very much to digital payments during the pandemic, and that trend has continued very strongly through the reopening. So I see this very much at the macro and the micro level. This trend is very strong and continuing.
Yeah, so very much something that's here to stay. Okay, so just to touch briefly also, obviously Europe is unusual in comparison to perhaps other markets in which PayPal operates, in that it's a collection of now 27 countries operating inside a single market. So maybe you could touch upon how PayPal helps enable those kind of cross-border payments, so within the European Union.
Yes, of course. Cross-border for us is one of our most important components of our offering. It accounts for approximately 20% or 1/5 of our global TPV at PayPal group level. In Q1 2021, we saw continued acceleration of that cross-border franchise, growing at 44% year on year. And that equates to about 50 billion of TPV just in Q1 alone. So very, very significant part of our overall value proposition and where we see our customer activity. That tends to be across the spectrum of high growth franchises, cosmetics, fashion, home furnishing, gaming, and electronics. All of those are heavily represented in that activity space. So a very important franchise for us, I would say. When I look at that space from the lens of a small business, of course, what they get when they're using PayPal is they're tapping into our two-sided network. When you look at that two-sided network, you see 75 million active accounts in the European Union, but you also see almost 400 million active accounts across the entire global population of PayPal account holders. So as a small, medium business, I'm using the PayPal brand and the opportunity of that trust and convenience to access that market. What we see is that SMBs who use PayPal are 3 times more likely to sell internationally. So there's definitely that consistency there that small, medium businesses are very much using PayPal for that cross-border activity. And one of the drivers for that, as well as our large franchise, is the opportunity that they have to leverage PayPal's fraud and risk analytics. As you can imagine, we see over 34 million transactions a day, and all of our analytics and fraud risk management capabilities that manage that and mitigate that risk means that that's available for small, medium businesses to enable them to sell cross-border. Without that capability, I think they would very much find it a difficult proposition. When I look across the European Union, we also have, with that 75 million internal customers, a very strong franchise for internal Europe activity. SMBs want to sell obviously internationally, but there's a very attractive market within the European Union itself, domestically, but also within the different market players. And we see that growing at over 41% year on year as well. So lots of growth opportunities for SMBs. By signing up with PayPal, they obviously get the opportunity for all of that access to those customers, but also the opportunity to leverage our technology and manage their risks as they do so in an effective and efficient way.
Yeah, so PayPal really acting as a platform in some ways for the platform and an enabler for the growth of small and medium enterprises to scale globally more than anything else. Just one more question to move to the kind of other tech end of the spectrum. So we obviously saw in the news relatively recently that PayPal has made an announcement that users will be able to buy and sell crypto in the US. Maybe you could talk us through some of the rationale behind that decision on the US side and when we can see that kind of thing moving over to Europe as well, perhaps.
Yeah, you're correct. We launched Buy, Hold, Sell, which is the original functionality for a crypto launch back in Q4. And that obviously was, coincided with the increasing interest for crypto among the investing community, but also in the wider communications and media franchise. So, the crypto product has obviously done incredibly well for consumers and investors in that time period. What we've seen is incredible engagement by our customers into that offering at launch and subsequently. People who have invested in crypto are effectively using their PayPal app twice as much, accessing it and using it twice as much as they would if they weren't using the crypto product. So it's been a very effective launch of a product from our perspective, and obviously from our consumers' perspective, accessing that new product. What we've launched subsequent to that is crypto checkout opportunities. So moving away from the investment concept, but towards the opportunity to use your crypto balance in everyday spend. That's obviously the long-term opportunity here, is to see the crypto balances as an ability to spend that money through your PayPal wallet. And again, that's been launched in this year in the US, and is again being taken up very attractively by the consumer population. That's something, when we looked at that product, obviously we've been doing it in hand with regulators. We work very closely with the New York Department of Financial Services to obtain a conditional bit license, which is a very first one issued. That allows us to offer that product in a very secure and efficient and compliant fashion for our customers. As we grow that offering out into Europe, we'll obviously working closely with European regulators on the same footing. And we hope to be able to partner with European central banks and other regulators in the rollout of digital offerings from central banks and others in that space. So our focus, predominantly from a European perspective, is to ensure that as we launch these products into our markets, that's done in a very compliant fashion with all of the legal and privacy aspects fully covered by dialogue with regulators in advance. Mm-hmm. Mm-hmm. And as we grow that market, obviously we're growing our capabilities internally. So we recently purchased a company in Tel Aviv called Curve that brings a lot of the capability in-house, additional resources, a team that's been working in the crypto space for a number of years. So as part of our expansion in this area, we've been building up our business unit and adding functionality both from external investments like our M&A posture, but also internally adding capability for this product.
Great. So hopefully in the fullness of time, we'll be able to get our Bitcoin via PayPal here in Europe as well. This is a great conversation, but unfortunately, we're running rapidly out of time. So I only have one last question for you, Sean, which is, what was the last thing that you bought using PayPal?
So yeah, I mean, PayPal for me is like an everyday occurrence, and our family are all very much active in the space. So I think there's probably a couple of things that have passed in the last 24 hours based on normal spend patterns. First thing I'd say is we've got a couple of older teenagers in the family, so food is a absolute must in the household, and a constant friend for us. So definitely we would have bought some takeaway food from local restaurants. Yesterday was a public holiday in Ireland, so the family food was collected. So I normally go for the collection route rather than delivery. I like the convenience of that. I go for a local restaurant and supporting the business as well. And then the second offering would have been we as part of lockdown we got a new puppy over the summer. So unfortunately he's very energetic, so he tends to go through toys at a rate of knots. So we're constantly buying tennis balls and anything that can keep him amused, and so he tends to lose them on our walks. So definitely would have purchased some equipment for him as well.
Okay, cool. Sean, it's been great to have you with us today. Thank you very much and stay safe.
Thank you very much, Chris.
So there we are. We're rapidly approaching the end of our session today, and I think one of the things that's a clear theme throughout all of the speakers is that Amazonization is very much something that's here to stay, and that it's affecting all aspects of financial services. It's driven by a far deeper understanding of the consumers, which is coming from the data side, and it's also driven by a desire for better customer experience and the loyalty of customers that comes with that experience. So I'd just like to take this opportunity to thank all of our speakers for giving up their time today to speak at the event. I'd also like to thank our sponsor, Fidelity, for sponsoring the event, and obviously you, the audience, for listening today. We will have a couple more Focus On events still this year, so please check out our website for more information about upcoming events. And if you want to find out more about Amazonization in particular, as I mentioned at the start, the report is linked in the event description for this event on our website, so please feel free to have a read there. And with that, thank you very much again for joining us today, and catch you at the next one.